Hey everyone, welcome back to Corporate Decoder. Today we are diving deep into Alto Ingredients Inc.'s latest quarterly report, and let me tell you, it is a wild ride with some spicy financial flavor and a dash of industrial grade risk. So buckle up, because we're about to decode what really matters in their numbers. And hey, if you are all about getting the unvarnished truth from these filings, make sure you are subscribed. We also have a fantastic community over on Discord, linked right down below, where we break down even more financial secrets. Alright, let's get straight into the heart of it, the balance sheet for the 30th of September. First off, Alabama to Ingredients had about $150 million in current assets. That includes things like cash and money that customers owe them called accounts receivable. Now, compared to the 31st of December of last year, their total assets went from a little over $401 million down to $388 million. So, a slight dip there, keep that in mind. On the other side of the coin, their liabilities. Total liabilities are hovering around $166 million. What is interesting here is their long-term debt, which actually increased from about $93 million to over $100 million. That is a bump up in borrowing. Now for the income statement, or as they call it, the statement of operations. For the 3 months ending in September 2025, Alto Ingredients reported net sales of $240 million, which is actually down from $251 million in the same period last year. But here is the kicker. Their gross profit, that is the money left over after paying for the stuff they sold, surged from about $6 million to a whopping $23 million. They turned a significant loss into much healthier profit in just one quarter. Looking at the 9 months period, net sales are down from $728 million to $686 million. But again, that gross profit more than doubled from $11 million to almost $20 million. It seems like they're doing something right to make more money from what they sell, even if they're selling a bit less overall. And because of that improved gross profit, their net income went from a loss of $2.4 million to a gain of $14.2 million for the 3-month period. For the 9 months total, they went from a $17 million loss to an $8.4 million loss. So they're still losing money overall for the year, but they are definitely on a strong upward trend, especially in the last quarter. Let's check out the cash flow for the first 9 months of 2025. They brought in about $3.7 million from their regular business operations. That is a bit less than the $6.2 million they got in the same period of 2024, but then their investing activities used up a lot of cash, around $12 million. This includes buying a company called Kodiak Carbonic for about $7.6 million. Then their financing activities brought in about $5.4 million. So overall, the cash piles actually decreased by about $3 million over these 9 months. Alto Ingredients breaks down its business into 3 parts: Pekin Production, Marketing and Distribution, and Western Production. The Pekin campus is their Illinois operation. Marketing and Distribution is pretty self-explanatory, and Western Production includes their plants in Oregon and Idaho. They report their performance based on gross profit, and it is pretty telling. Western Production is still showing a gross loss for the 9-month period, which is a big number, close to a $15 million loss. But look at Pekin Production and Marketing and Distribution. They're both showing healthy gross profits. The Western Production segment's loss narrowed significantly compared to the previous year, which is a good sign, but it is still a drag on the company. Inventories were pretty stable, around $53 million at the end of September 2025. This includes things like their finished alcohol products, raw materials like corn, and stuff that is in the middle of being made. As a company that deals with commodities heavily, they use derivatives to manage price risks. For example, they use contracts to lock in prices for corn and alcohol. These are not for betting on the market, but for protecting their profit margins. For the 9 months of 2025, these non-designated hedges resulted in gains of over $10 million, which is a pretty good chunk of money helping them out. On the flip side, in 2024, these contracts also resulted in gains of around $9 million. So these derivative contracts are clearly playing a significant role. Let's look at their debt. They have a line of credit from Carnegie and a term loan from Orion. The total long-term debt is about $100.6 million, which is up from $92.9 million at the end of last year. They also mentioned they have about $20.3 million in unused borrowing capacity on their Carnegie line of credit, which is good for flexibility. They have sales contracts in place for millions of gallons of alcohol and tons of ingredients. They also have purchase commitments for corn and natural gas. This shows they have a pretty solid plan for what they expect to buy and sell in the near future. They also mentioned general litigation, but they believe these cases won't materially affect them. That is usually a good sign, but something to keep an eye on. This section talks about how they value certain assets and liabilities. For most of their financial instruments, they use observable market data, which is level 2 in the fair value hierarchy. But for things like their long-lived assets at the Magic Valley facility, which they've idled, they use estimates based on future cash flows. So that is level 3. This means there is more guesswork involved in valuing those assets. Here is how the profit or loss breaks down per S-hair. For the quarter ending September 2025, they earn 19 cents per S-hair, which is a huge jump from a loss of 4 cents per S-hair in the same quarter last year. For the 9 months, they are still at a loss of 13 cents per S-hair, but that is much better than the 25-cent loss per S-hair from the previous year. This shows improving performance on a per-share basis. This is where the company management explains what is going on. They highlight strong market conditions and strategic realignments. They're seeing growth in higher margin fuel exports and benefiting from their liquid sea or acquisition. The goal is to lower their carbon intensity score to get more tax credits, which seems to be a big part of their strategy for future profitability. They are also looking at options for their Magic Valley facility, which is currently idled, including possibly selling it or using it for sea or utilization. This section really shows the story. While net sales are down slightly, their gross profit percentage jumped from Baffinja Ardenses to Baffinja Jodense for the quarter. That is huge. It means for every dollar they sold, a lot more of it is sticking around as profit after covering the direct costs of what they made and sold. The 9-month period also saw a similar improvement, with gross profit percentage going from Baffinja Idianwu to Baffinja Ardenjiu. This improvement is driven by a lot of factors, including higher renewable fuel exports, their new liquid CO business, and cost savings from idling the Magic Valley plant. Their selling, general, and administrative expenses, or SG&A, went down significantly. For the 9-month period, it dropped by about 18.6%. This is due to things like staffing realignments and fewer acquisition-related costs. They seem to be doing a good job of controlling these overhead costs. So after all the accounting, the net income attributable to common stockholders went from a loss in 2024 to a profit in 2025 for the quarter. For the 9-month period, the loss narrowed considerably. They attribute this improvement to better margins and lower operating costs, especially from idling the Magic Valley plant. During the first 9 months of 2025, they funded operations mainly from their cash on hand and their line of credit. They have over 33 million in cash and equivalents. They also have a decent amount of borrowing capacity. They seem to think they have enough money to keep things running for at least the next year. This credit line is quite detailed. It has specific limits on how much their subsidiaries can distribute to the parent company, and it is secured by all their tangible and intangible assets. They seem to be in compliance with the financial covenants, which is important for maintaining access to that credit. This loan has a fixed interest rate of 10% and matures in 2028. They have to make prepayments based on their excess cash flow, and so far no prepayments have been made or required. The outstanding balance is 60 million. This is all about how Alto Ingredients is exposed to risks from changes in market prices, especially for ethanol and corn. They use hedging strategies to manage these risks, but they admit these strategies can sometimes lead to losses. They even provided a sensitivity analysis showing that a 10% adverse change in ethanol prices could hit their pre-tax income by about 20.8 million, and a similar change in corn prices could impact it by 18.6 million. This highlights how crucial commodity prices are to their bottom line. The risk factors section is always a good place to see what keeps management up at night. They're heavily exposed to volatile commodity prices like corn and natural gas. Disruptions in their production or distribution, whether from weather, equipment failures, or even climate change regulations, could seriously hurt them. They also talk about potential impairments in their long-lived assets, meaning some of their buildings or equipment might lose value. And of course, there are risks related to new technologies that could make their current processes obsolete. And for investors, they warn that their stock price is highly volatile, which means big swings up and down are possible, and that could mean substantial losses. They also mention they don't plan to pay dividends anytime soon, meaning investors will only see returns if the stock price goes up. So what is the story here? Alto Ingredients seems to be navigating some choppy waters with improved profitability in their core operations, particularly in the last quarter. They're smartly hedging their commodity risks and cutting costs, which is evident in their surging gross profit margins. The acquisition of Kodiak Carbonics seems to be paying off, adding a new revenue stream. However, the Western production segment is still a significant loss leader, and idling their Magic Valley facility while saving costs also means lower sales volumes. Their future hinges on successfully managing commodity prices, benefiting from tax credits for low-carbon fuels, and hopefully turning around those Western operations. They're clearly making strategic moves to improve profitability, but the inherent volatility of their industry and the significant risks outlined in their report mean investors should still tread carefully. Alright? That is our deep dive into Alto Ingredients' latest 10Q. What do you think of their comeback story in the last quarter? Are the cost savings and strategic moves enough to overcome the risks? Let me know your thoughts in the comments below. If you found this analysis valuable, hit that like button, it really helps us out. And make sure you are subscribed for more corporate decoding, and don't forget to join our growing community on Discord. The link is in the description. Thanks for watching, and we'll see you in the next one.